Welcome to This Explainer. Okay, today we're tackling two absolute heavy hitters in the audit world. Look, management gives you the books, they hand over the financial statements, and they'll tell you everything is perfectly fine. But as an auditor, your job definitely isn't to just nod and smile. Your job is to trust, but verify. You have to independently validate those numbers. So we're diving deep into the ultimate auditor's playbook today, specifically focusing on two absolutely crucial standards, SA 505 and SA 510. By the time we finish this, you're going to have everything you need to master these concepts and honestly crush your exams without ever having to reopen that heavy textbook.
Here's our roadmap for today. First, SA 505, external confirmations. Second, managing responses and refusals. Third, SA 510, initial audit engagements. Fourth, verifying opening balances. And finally, forming the audit opinion. Let's just jump right in. Section 1, SA 505, external confirmations.
Think of this as your primary investigative tool. When the internal documents just aren't enough to give you peace of mind, you need direct testimony from independent witnesses. Now, pay close attention to the precision of the language here, especially if you're prepping for exams. You need to isolate this exact definition. External confirmation is audit evidence obtained directly by the auditor from a third party in written, electronic, or any other suitable form. The whole goal is to get highly relevant and reliable evidence. And the key word? Directly. You do not ask management to ask the bank, you ask the bank yourself.
So, what does this actually look like in the real world? Well, it's super practical. You're reaching out to banks to confirm cash balances or maybe loans and guarantees. You're contacting customers, the trade receivables, to make absolutely sure they actually owe the entity what the books claim they owe. You might talk to custodians who are holding investments, or even send a letter to the company's lawyers to confirm the status of ongoing legal cases. It's all about verifying the internal story with external reality. There are two main ways you can ask for this evidence: positive confirmation and negative confirmation. With a positive confirmation, the third party has to reply in every single case. Even if they completely agree with the balance, they still have to send a response saying, "Yep, this is correct." Because of that, it's highly reliable. Negative confirmation, on the other hand, means they only reply if they disagree. If the balance is fine, they just stay silent. Now, because silence could just mean the letter got lost in the mail, negative confirmation is way less reliable. You really only want to use it in very specific, low-risk scenarios where there are strong internal controls.
Let's look at a real-world scenario to understand what we call an exception. Picture this. You send a positive confirmation to a customer. The entity's books show a debtor balance of 5 lakh rupees. But the customer replies and says, "No way, I only owe 4.8 lakh rupees. That difference right there, that is an exception. Whenever the entity's records and the third-party testimony just don't match, the auditor has to investigate. Is it a simple timing difference? Is it a silly recording error? Or is it fraud?
To make this whole process work, the auditor absolutely must maintain complete control. Listen, this is a massive exam keyword. Auditor maintains control. You determine the information to confirm, you select the parties, you design the requests so they have proper authority and correct addresses, and most importantly, you send the requests directly and receive the replies directly. Why go through all that trouble? To prevent management from intercepting the responses, manipulating the replies, or sending fake confirmations to cover their tracks. You have to hold the reins.
Section 2, managing responses and refusals.
But what happens when things don't go smoothly? Imagine you're sitting in the boardroom and management looks at you and straight up says, "Don't send a confirmation to XYZ customer." They are putting up a major roadblock. As an auditor, alarm bells should be ringing loudly in your head. You're suddenly facing a potential limitation on the scope of your audit. You definitely can't just nod, agree, and move on.
When faced with this kind of refusal, there are exactly 4 procedural steps you must follow. First, ask for the reason. Second, evaluate the validity of that reason. For example, maybe there's a highly confidential legal negotiation happening, and sending a confirmation might genuinely ruin a sensitive settlement. Okay, that could be valid. Third, whether the reason is valid or not, you must perform alternative audit procedures to get the evidence some other way. And fourth, if their refusal appears completely unreasonable and you still can't get evidence, you have to treat it as a scope limitation, and that might force you to modify your final audit opinion. Let's zoom in on step 3 for a second. What exactly are these alternative procedures? Well, if you can't get a confirmation back, whether management blocked it or the third party just ghosted you, you need a backup plan. For a debtor, you might examine subsequent cash receipts to see if they actually paid up after year-end. You can check sales invoices, delivery challenge, goods receipt notes, contracts, or bank statements. Basically, you have to piece together the evidence internally to prove the external reality. Now, external confirmations are fantastic when you're checking the current year's activity. But what if you're stepping into the shoes of a new auditor? What if you are auditing this entity for the very first time and you're forced to rely on numbers you didn't even audit last year?
Section 3, SA 510, Initial Audit Engagements.
The stakes here are incredibly high. It's kind of like inheriting a cold case. You cannot blindly trust the closing numbers left behind by the previous auditor because those numbers are the entire foundation of your current year's work. These opening balances are the balances existing at the beginning of the current year. But it's not just the numbers. Yes, it includes the closing balances of the previous year, but it also includes any unresolved previous issues and the existing accounting policies. A wrong opening balance acts literally like poison. It will corrupt your current year's profit, your assets, liabilities, the whole equity. It is the critical baseline.
Section 4. Verifying opening balances. So, how do we make sure that baseline isn't built on sand? As the incoming auditor, your responsibilities under SA 510 are crystal clear. You must obtain sufficient appropriate audit evidence that the opening balances are completely free from material misstatement. You also need to double-check that the previous year's closing balances were actually carried forward correctly to the current year. And finally, you've got to verify that the accounting policies are being consistently applied, or if they did change something, that it's properly disclosed.
To gather this evidence, your audit procedures are going to look a bit like this. First, with management's permission, of course, examine the previous auditor's working papers. You should absolutely read the previous financial statements and that previous audit report. Then, you dive into the substantive procedures. For current assets like debtors, check the subsequent receipts. For current liabilities, check subsequent payments. And for non-current assets, you hit the fixed asset register, verify ownership, and recalculate that depreciation. Now, let's talk about a very specific and kind of tricky challenge: inventory. If you are appointed after the year already started, well, you obviously weren't there on day one to observe the opening inventory count. So you perform an inventory rollback. Basically, you observe the current inventory on a later date, and then you just work backward. You verify the rollback by examining the purchase and sales records that happened between day one and your current count date, just to reconcile it all back to that opening figure.
Section 5, Forming the Audit Opinion.
Ultimately, all of this digging, whether you're sending confirmations out under SA 505 or verifying opening balances under SA 510, leads to the grand finale of your job, forming your final opinion. If you find a material misstatement in the opening balances and management just refuses to adjust it, or if you simply cannot obtain enough evidence despite running all your alternative procedures, you have two main options. You issue a qualified opinion if the issue is material but not pervasive, meaning it affects a specific area but the rest of the financials are okay. But if you suffer a severe scope limitation, say management blocked your confirmations and you couldn't get evidence anywhere else, making the issue both material and pervasive, you issue a disclaimer of opinion. That effectively states you cannot sign off on these financials. Okay, let's lock all of this in for your exams. Here is your first cheat sheet matrix for SA 505. Let's compare positive and negative confirmations side by side. Is a reply compulsory? Positive, yes. Negative, no. Reliability? Positive is high, negative is quite low. Suitability for high-risk audits? Positive is a yes, negative is a firm no. Does it detect fraud better? Positive definitely does, while negative has very limited ability to catch any fraud. Take a mental snapshot of this. It is going to be incredibly useful for quick revision. And let's move right to our second cheat sheet, this one for SA 510 on initial audit engagements. What's the main focus here? Opening balances. What are you checking? That they carry forward correctly and that accounting policies are consistent. What about inventory? You either observe it or do alternative procedures like the rollback we talked about. And what do you do with the previous report? You meticulously review it for any modifications that might still affect the current year. This matrix honestly gives you everything you need without drowning in a textbook. Before we wrap up, I want to vocally highlight these exact exam keywords. Examiners are literally scanning your answers for these specific terms. You've got to use phrases like direct evidence, independent source, positive and negative confirmation, alternative procedures, non-response, exception, and most importantly, auditor maintains control.
Injecting these exact words into your answers shows a really professional command of the ICAI standards, and that is what will score you maximum marks.
We've covered a lot of ground today, right from interrogating third parties to verifying an inherited past, but I want to leave you with this final thought. Think about the immense responsibility of being an auditor. If you can't trust the starting line, those opening balances, and if you can't independently verify the reality outside the company's walls, how can you possibly verify the finish line? Keep that investigative mindset sharp, remember your core procedures, and you are absolutely going to master these concepts. Thank you so much for joining me on this explainer, and happy studying.